Have you ever wondered why professional investors sometimes make bad investment decisions? After all, portfolio managers and investment analysts are highly educated, experienced, and have access to vast amounts of information. Yet, even the best investors are human. And that's exactly what Nobel Prize winning psychologist Daniel Kahneman explained in his famous book, Thinking Fast and Slow. Kahneman argued that our brains operate using two systems. System one is fast, intuitive, emotional, and automatic. System two is slow, analytical, rational, and deliberate. The problem, even professional investors often rely more on system one than they realize. One of the most common biases is called recency bias. Imagine an analyst meets the CEO of a company on Monday. The CEO is charismatic, confident, and tells a compelling growth story. That meeting is fresh in the analyst's mind. By Friday, when making investment recommendations, that recent positive interaction may have a disproportionate influence on the decision. Not because the fundamentals changed, not because the valuation improved, but because the human brain naturally gives more weight to recent experiences. I've seen this throughout my career managing billions of pounds in investments. The company management team that gave the best presentation often received the most attention. The stock that was discussed most recently often felt more attractive. The latest narrative can easily overpower years of historical evidence. That's not the only bias. Another powerful behavioral trap is loss aversion. Kahneman's research showed that people feel the pain of losses roughly twice as strongly as the pleasure of gains. This explains why many investors hold on to losing positions for far too long. When a stock falls 30%, selling forces us to admit we made a mistake, and psychologically, that's painful. So instead, investors often tell themselves, it will come back. The market is wrong. I'll sell when I break even. But markets don't care about our emotions. The result? Small losses can become large losses. Professional investors are not immune. In fact, sometimes experience can make the problem worse because confidence can reinforce existing beliefs. The best portfolio managers understand that investing is not just about analyzing companies, it's about managing your own psychology. That's why successful investment firms use structured investment processes, challenge meetings, independent risk reviews, and disciplined portfolio construction. These systems are designed to reduce human bias. Because investing isn't a battle against the market, it's often a battle against yourself. As Kahneman famously demonstrated, understanding human behavior may be one of the most important investment skills of all. The question is, how often are your investment decisions driven by facts? And how often are they driven by psychology? Subscribe for more insights on investing, behavioral finance, AI, and wealth creation. Join AIMi for free at chataimi.ai and learn how institutional investors think about markets, risk, and decision making.